Good afternoon, everybody. I thought that was a rather apt little intro with the, not you, Julian, actually, but the mineral valuer and the JORC compliance. I am defined under JORC as a competent person. They call it qualified person in Canada. Those that aren't defined as a competent person, hence the opposite. The secret of the Golden Hinds, the secret of the Old Pirate's Treasure and the Golden Hind and those kind of things is what we're going to run through today. And, mineral exploration and discovery is part science, part art, the level of creativity. It's something the valuers, I think, be intrigued to talk to Michael a little bit more about mineral valuation to make it realistic. Because one of the key aspects of it is understanding your information and understanding your system geologically. And if you've ever stood an outcrop with 3 geologists, you generally have 4 opinions, and they're all wrong. I am a geologist. I can't actually see my own slides here, so this is going to be a little bit of a challenge. Oh, down there. There we go. There's the full definition of my competency, along with the I am a geologist, and also the disclaimer. We're not touting for shares today. All right, our chairman is here today, Dr. Mike Etheridge. Mike, raise your hand. He's the only guy not in a dark suit. He's got the tweed on. Myself, I'm the managing director of ABM Resources, a company that was sort of reinvented 3.5 years ago from a shell vehicle. Iman Skins is a non-executive director. He's an economist. Graham Sloan, a mining engineer, and Andrew Ferguson, based in Hong Kong, representing our largest shareholder, APAC Resources. Also draw attention to, we have a mining engineer because we're building a mine now. Before that, we were just a whole lot of explorationists, but we're going to give it a real crack. You'll see about it. All the other stuff, that's, shares and issue, all that kind of thing. Fairly boring for a scenario like today, but where are we? So we go back 3 years. We essentially acquired the largest land position in Australia for junior gold, 33,000 square kilometres. That's, I refer to that as 0.4% of Australia's continental landmass. Being continental, I don't count Tasmania. The main project we're talking about today is up in the northwest. It's called the Twin Bonanza project. We're in the Northern Territory, about 700 kilometres northwest of Alice Springs. This is a project that we bought from Newmont. The other stuff we compiled, we've got some projects from Tanami Gold that we've ended for stock and scrip, stock and cash, and for Newmont we paid straight cash for these projects. It's a very large land holding. I'm going to tell you why we wanted to accumulate such a large land holding, because this is the most underexplored part of Australia. And really, if you chart the history of discovery in this country, we chart it from a coastal. Everyone thinks of Australians as being, bush-dwelling, Crocodile Dundee type figures, but we're a nation of coastal dwellers, really. And if you chart inside, you've got the first gold discoveries up near Bathurst as the convicts got up there, and then Victoria, and then Western Australia, and then it all stopped. And that whole central part of the middle of Australia was really left unlooked at for a long period of time, give and take a few other bits and pieces. So I'm going to tell you about how we got Old Pirate and what it looks like now. It is we refer to it as the best high-grade, never before developed gold deposit through 700 kilometres northwest of Alice Springs. Put as many qualifiers in front of that to call it the best as you like, but it's basically we have coarse visible gold at surface. This was missed in the gold rush. That's the most important thing about the aspect of this. And it's the way that we're treating it. From a strong technical background, we're treating it like old-time miners in many regards, and I'll tell you about that. Basically, if this was in the gold fields of Western Australia, it would have been mined 100 years ago. Right? If this was in West Africa, it would have had hundreds or thousands of artisanals over it. If it was up in the highlands of Papua New Guinea, maybe it would have been missed under the jungle, but really somebody probably, landslide would have pulled it out or something at some stage. But in terms of Australia, to get an old-time type discovery in the modern era is what's significant about this. So our current resource is 600 to 700,000 ounces of high grade from surface to a couple of 100 meters depth. The reason why we bought this project from Newmont, though, was because of a porphyry. And the porphyry is a bulk tonnage, low-grade systems, and we were kind of intrigued by it. The only one ever in this district. So we purchased the project on the basis of that with this odd thing off to one side. And, of course, this whole regional exploration portfolio, this 33,000 square kilometres that we don't leave fallow. We've made other discoveries, or we've worked up some other mineral occurrences in and around that. This company was a standing start 3 years ago, really, or 3.5 years ago. This is what the share price graph looks like. Bear in mind, we've got a few billion shares in issue, but really from our lows in 2009, from the reinvention to the highs, was 800% increase. If you're bored at the high and you're still holding, you're down below 60% loss on that. Generally, our highs were up on the backs of discoveries, and unfortunately, Tanami Gold, one of our largest shareholders, was struggling with debt, and it's well published on that. They had a high debt level, and Coyote wasn't performing well for them, so they did start selling our stock, and that put downward pressure on our stock price. But we are right here, right now, with no debt, ready to build a mine. We don't need debt in order to build this staged approach that we're going through, and that's what's unique about the thing that we're trying to achieve out here at Old Pirate. In terms of enterprise value, which is of course a good metric to look at as well, from what was essentially a shell. It's a fairly expensive shell, I must say, at $6 million, but sitting around enterprise value of about $84 million as we stand today. So we go back 3 years, and we go back to, I was based up in Canada for a while, and I'd worked with Mike before, and I was kind of presented this concept of the Tanami, and it's an area I did a little bit of consulting for back in the fractal geoscience days for a group called Otter Gold up in that area. And it's like, well, why do we like this area so much? Why is it untapped? And this is a graph of a distribution of gold deposits in other Proterozoic gold terrains in the world, principally the Birimian of West Africa, Ghana, Mali, Burkina Faso, and Guyana. This is 3 years ago. This is a slide I put together for the very first presentation. Julian asked me to come down today and tell a story, so we're going back 3 years on this. And you can see that generally in mature belts, you get a log normal distribution. Same thing in Western Australia, same thing up in Timmins and the Abitibi of Canada. You get a log normal distribution, you get one really big deposit, you get some really good tier 1 world-class deposits, and you tail off with a number of smaller deposits. But with the Tanami region, with the central desert of the Northern Territory, it never followed that because it just hasn't had the work. And the biggest deposit discovered was actually discovered in the 1990s. And that was significant. It hadn't been discovered in the 1800s and been built on and grown. It was discovered really, really late. It's like the Carlin trend in Nevada was discovered in the 1960s. I consider that the modern era, not the prospecting era of discovery in this world. And then so if we look at the world, and this is similar as the slide from 2009, when I first joined the company about November 2009, said, well, let's look at all the gold camps around the world at the time with individual deposits greater than 5 million ounces. Right? And there's a stack of them, right? There's Pacific Rim, of course, there's parts of Russia, and there's Africa, and all that kind of thing. Let's remove the Fraser Institute's bottom 2/3 or so at that time, right? The really risky places. Peru and Chile were actually classed as low risk back then. That has changed a little bit since then. But we're really left with North America with mineral deposit potential, and Australia at that point. Let's remove the mature camps, what I just talked about, the declining discovery rates, the things like, the Timmins discovered really early, and the Vits discovered early, and in Western Australia, Kalgoorlie discovered early, and everything's generally been getting smaller. And we're left with the Carlin trend, of course, discovered in the 1960s, some things in Alaska and the Yukon, and some nice things down in South America in the modern era. And in Australia, we've got the Lachlan Fold Belt, we've got Roxby Downs, Olympic Dam area as well. Issues of infrastructure, high access, cost of exploration. I've been working in North America before that. I've been up in Alaska and British Columbia and paying plus $1,000 per meter for drilling by the time you put the helicopters on. Let's look at where the postage stamp land positions are. We can't get a land holding because it's all little postage stamps. And if we want to deal with a company or try and acquire, let's look at companies or land holdings greater than 10,000 square kilometers, because we didn't want to spend 3 years trying to accumulate ground. And it left us with the central desert of Australia, really. That was, obviously put together a little bit in hindsight, and we intended to be left with the central desert of Australia. I do want to make mention, success, of course, can have many parents, and acknowledging North Flinders, Normandy, and Newmont geologists who did work on this project and have spoken to me since we've opened it up, saying how they really believed in this project early on. And I've put some names down there: Tony Schreck, Jeff Lowe, Andy Beckwith. If there's any others in the room that was on this project in the mid-1990s, I do apologize. But North Flinders essentially discovered the mineral occurrence here at Old Pirate, taken over by Normandy, of course, for the Cali discovery, taken over by Newmont, of course. We got the project started drilling in 2010, and we drilled on the Buccaneer Porphyry. Also in 2010, we said, okay, let's go drill 5 holes at Old Pirate. Hole number 1, we hit 35 meters at 6.5 grams, and we thought, oh, man, this is easy. This is so easy. And holes 2 and 3 and 4 hit not so much, and really drilled into the same structure, so that was intriguing as well. And then hole 5 hit 5 meters at 274. We continued with a few patchy drill results, and we're still seeing this coarse gold at surface, and we're panning gold out of RC drill chips, and we're really just scratching our heads, and really takes us through to 2011 when the penny drops about how to understand this system, how to understand doing something a little bit unorthodox, but it's something that isn't necessarily mentioned too much in JORC, but it's trying to think like an old-time miner, essentially. So solving the Nugget effect. This is a coarse gold system, right? Plenty of these systems around the world, and people often treated it as a bad thing because Ballarat and Bendigo are high Nugget effect systems, but it means I can have two samples from exactly the same spot, and they can have very, very different grades. A duplicate can have very different grades. So Simon Dominey, who's a world-renowned expert in coarse gold, based down in Victoria these days, which is a good place to be for a coarse gold person, was, well, you've got to do a bulk sample. And we had no mill, we had no permit to do a bulk sample. And he said, well, what else you got? I said, well, it's sticking out of the ground, it's outcropping. He goes, well, try and collect as much of it as possible. So we took the backhoe out there, and we started to expose the veins along the strike length. Map the pinch and swell. They go from 6 meters wide to 20 centimeters wide, and back out again and back in again, and understand the geometry and the shape. But the main thing was we were collecting more and more samples. The first batch of longitudinal sampling had 116 meters of strike length of vein, along the length of the vein, at 19 grams. I thought, oh yeah, that's pretty good. But it was only 1 in 4 samples were actually carrying grade. And so it was this positive skew, and these much larger sample sizes, these bigger samples. I thought, oh, you know what? Remember those first 5 drill holes that we drilled? That was actually, we had 2 out of 5 drill holes on that hit. That's actually not bad, considering the samples. Bear in mind a piece of drill barrel's like that sort of wide. So fast forward to 2012, we continued on this program, as well as drilling. You know, people say, oh, you've just done the surface sampling. You know, we've drilled 70,000 meters, or compiled 70,000 meters of drilling through this as well. But we have 2 kilometers of strike length averaging greater than 25 grams per ton, undiluted. So that's sampling to vein width, right? So we do dilute it prior to using it in the resource. And we're finding new high-grade veins all the time. So it has coarse gold, and sometimes, you know, I've come across an analyst that thought that coarse gold and refractory gold were the same thing. Coarse gold is not a bad thing. Coarse gold is actually really, really good. It's hard to estimate the amount of its content in there. And we, you know, if we go to our JORC 2012 compliant report, Sue, where we disclose all the different processes that we've gone through on that, our test work is showing that we can recover 97% of the gold through gravity only, or up to 97%. That's the best result we've had. What's more, when we collected 200 kilos of sample from 5 or 6 different veins, we thought the grade of that was 20 grams per ton. Right? Oh yeah, we want to put a bit of high grade in there, thought it was about 20 grams per ton. But when it went through the 2 engineering companies for gravity test work, one of the samples returned 40 grams and the other one returned 140 grams per ton equivalent. So we had a massive overcall on what we thought the grade was going to be. It's not that one company was better at extracting gold than the other, it's just they had more globs of gold. It's like they had the other half of the drill core. When I have one half runs 95, and the other half runs 5. I've got some samples on the table if Julian hasn't mixed them up with his entree. And you might break your teeth on them. So feel free to come and have a look. Now, we only allow the top, we do normalize all of our surface work to ensure that it's only representing a meter wide, right? So that's really important. We consider that a mining width potential. But if we just use drilling in that, and many of the analysts or many of the investors in this room, we're quite scared about this very bottom number here, right? We have 1,152 intersections of drilling in high-grade vein. For a system of this size, that's actually quite a lot. That's well drilled, basically. But that only amounts to 2,000 kilos of material, or 2 tons of sampled material. I'm not even going to discuss the 30 or 50 gram assay that's taken. We do take multiple assays per high-grade sample. The surface work has added 10 times more material. Larger sample sizes and coarse gold systems get better results, and that's really important. We pan gold out of our RC drill chips. See lots of nice visible gold at surface. Again, something that's pretty much unique in this country in the modern era. Some of the gravity test work showing down on that. I think I missed. thought I'd missed a slide somewhere in that, but anyway. Oh, yeah, I was coming to that. I'm getting a bit mixed up here. These are some of the examples of our longitudinal test work. So this is continuous sampling along the strike length, and we're 1.8 k's of overall strike length, multiple veins through that. The northern end of the western limb there, it's 20 centimeters wide, but the vein is, the system is more like 5-10 meters wide up on that western limb. But these are the surface grades from that longitudinal trenching work, averaging 73 grams. Got to dilute that out before incorporating into a resource, but showing some of the spectacular grades for minimized dilution. The heartland veins, again, up to 750 grams per ton at surface. These are the kind of things that made the fortunes of guys like Paddy Hanlon and stuff in the 1800s. Central zone, get up to 5-6 meters wide in there, and we're still averaging 1.5 ounces per ton. East side, a couple of meters wide, 54 grams per ton. East side north, it goes from 2-3 meters wide down to 50 centimeters wide, but still 90 grams per ton in that. Then we get this blowout at Old Pirate South, the veins 20 centimeters wide, then all of a sudden it's 6 meters wide. And that's still carrying an inordinate amount of gold. And those that are familiar with investing in gold companies will know that 2 grams per ton is generally a pretty good surface number to have. And these are dealing with 70 grams per ton on that. And then the Golden Hind, which is off to the south, and I'll tell you about the discovery of the Golden Hind momentarily, and it's the southernmost vein that we've got high-grade gold in. Bear in mind we have a lot of quartz out here without that much gold. Forex Island. So this is one for Jork, and this is a quote from a guy called Harry Park, who's a famous North American resource geologist. But, we went out to the consultants, and no offense to the consultants in particular, but went out to the consultants to talk about a resource, and these consultants kind of become a little bit widget factory in their approach. It's about geostatistics, how's your variogram, what's this doing, what's that doing, and they will leave the geology behind. So we really felt, we only have a little bit of sampling, right? We've got 22 tons of sampling, basically. And we've got a little bit of statistics, but let's really concentrate on the geology and understand the geology. Of course, add some common sense and get our resource. And beware of the volume variance effect. That is, the larger the sample, the better the grade in the coarse gold system, generally. Somebody heckling? It's been a bit noisy now. Okay. So the Old Pirate resource... this is kind of what looks like slightly 3D view of a geological map, but it's a south plunging anticline, multiple faults coming off. Understanding that, remember that we're dealing with, on the order of the quartz veins, around about 80-90% exposure of our quartz. So we've been able to understand this, having a complete level through, which is kind of unheard of also in the modern day of that. South plunging folded turbidite sequences will sound familiar to the Victorians. How do we build the resource? We kept the statistics simple. We understood that the statistics are a function of the sampling and the function of the spatial distribution of the sampling. So we understand there's inherent limitations in that. We have 0.0013% of sampling representation for 1.8 million ton resource. Now that is really, really scary. That's like asking, 5 people who's going to win the next election and coming up with a well, actually, if you ask 5 people in this room, you'll probably get the right result. But but in a normal election, Julian, but it's not a decent representation, but it's actually quite normal. And that's why I'm intrigued about the mineral valuers and whether or not they're going to use that in the valuations and understanding those kind of things. Because there's pretty much not another industry in the world that would use that kind of. But we also have, remember, we've got 10 times more surface volume for sampling than what we have in terms of drilling as well. So we treat it all separate, very nice search width. We don't smear those surface results. We only let them influence top 20 or so meters. We're letting the grade and nugget effect be the upside, not the downside. So we're conservatively bringing it down using dummy samples and various things in that. We have inherent dilution built into our model so that we can look at mining this, possibly increasing the grade on mining. But most importantly, to build a mine plan and a strategy. So this is the Old Pirate resource. Touched on that before, currently 600,000 ounces to 700,000 ounces, top 200 meters. It's kind of what it looks like if you strip off the surface through there, over this 1.8 kilometer strike length. Through there, it's an inverse distance model. We did a scoping study in May, which I won't dwell on because it's essentially out of date with the new resource that we just updated anyway. But we're about to enter trial mining, which will give us our total costs. But the numbers here are around about the order of magnitude that we're still finding in terms of our total cost per ounce of that sort of $500 to $600 per ounce production costs in there for gravity recovery only. We're looking at one of Australia's free gold mines without using cyanide. So this is real the crux of the matter, and I think this industry has largely failed its investors in many respects, right? So not always. There's been some fantastic success stories, but 70% of projects, this is a number from Peter McCarthy, the AMC, sort of paraphrased out of one of his presentations, but I heard this number before as well, fail to achieve the expected outcomes based on the full feasibility study. So that's not because, you know, geologists or mining engineers or accountants or mineral valuers or anybody's any bad, they're not that bad at their job. It's just this inherent uncertainty through all that. If I say I've got 85% confidence in my resource, that's actually quite good. That's actually certainly well within something that if it was evaluated by someone like Michael, would say that's a good confidence level. Put 85% confidence in and around your recoveries and your OPEX assumptions, your CAPEX assumptions, and your future gold price, and all those kind of things. They can potentially multiply as probabilities and reduce the chance of an expected outcome, right? Our industry is unfortunately littered with gold projects and gold mills out around the place that are lying dormant because they've built something that's too big for a deposit that they need to use. In some cases, it needs more mills, and other places need less. This is a photograph I borrowed from Ivanhoe's website, and I was always impressed with this picture when I first saw it. It was a drilling out of the Merlin deposit, which doesn't come to surface. It's a molybdenum deposit in the Northern Territory, in Queensland. But we can see 4 or 5 drill rigs drilling there, and you know, Friedland just loves that. That's just brilliant. And I agree, that's fantastic. That is good geological budget to get those kind of things. But we decided to understand this system, which is an old school system. We need to think more like the guys down the bottom, except the bit with the shaft and the beards and stuff. But we needed to think more like that in there. You know, there's 30 million ounces mined out of Kalgoorlie in the Victorian goldfields before drilling technology was ever applied. But all JORC talks about is drilling and how you have to declare all your drilling information in that, right? Again, no offense to JORC, we're all totally JORC compliant, we're all competent people. But our approach is a more of a staged approach, which is taking advantage of the 3 key engineering advantages here. And that is, we are high grade. We think that we have a resource 10 times higher than that of just about any other open pit knocking around in Australia. No pre-strip. The very first scoops contain gold. There's some of it, there's some of it on the table here. And the gold liberates really easily from the quartz. So we can follow these things along. So instead of spending $20 million on a feasibility study and doing the full drilling, right, it's actually cheaper for me to actually start digging it. Now, it's hard for some of the analysts to get their head around those kind of things. And they say, oh, well, how are we going to be able to, value you if you don't have a full feasibility study? I said, well, it's kind of your job. You're meant to be able to do those kind of things. And certainly some of the analysts I know in this room have never asked me that question, but I've had some of the other ones externally have asked me that. So we're going through this staged approach. Stage 1 is the trial mine, and I'm happy to say that we have started breaking ground on this. We start digging ore this month. Remember, first scoops contain ore. We have a permit to do 10,000 tons under exploration license. The processing is scheduled to commence in July. In the beginning of July, a small-scale gravity gold plant is going to be installed on site. It's not quite going to be a stamping battery with a whole lot of sluice boxes like in the old days, but it's a modern version of that kind of thing, really, because we have an old-style type deposit. The total cost of that whole process, including the digging and the capital expenditure and those kind of things, is around about $2 million for the plant, about $1 million to install it, a couple of $1 million to dig it, right? And we're anticipating we've got a base case scenario of 3,000 ounces of gold produced. So it it did used to pay for itself until the gold crash came along. Stage 2 is to continue open pit mining after that, obviously dependent on a bulk sample. Gravity gold, right? Now, to have 90% recoveries from multiple pass in this district is not unusual. Down at Cali for Newmont, they operate in the 80s, right? In the mid-80s on single pass through Nelson with a massive big CIL or CIP circuit at the end of it, and they can kind of be a little bit lazy around the gravity recovery because it's going to the cyanide anyway. Same thing at Coyote. We have multiple passes. We've got a jig, and we've got multiple passes through a Nelson concentrator. So expect somewhere in the 90s and certainly low 90s is well and truly adequate. The great thing about gold, and the reason why gold is still valuable today, is the great thing about gold and why it's still valuable today is if you don't recover it all, it doesn't go anywhere. We put it into a little dam, and we can always come back and get it later through some other process as well. So this is the equivalent of our feasibility study. Beyond the trial is stage 2, We can use that same plant with our 3-4 week payback period that we have on it. We can use that same plant with only some minor improvements to do 150,000 tonne per annum. 150,000 tonne per annum at 10 to 12 grams per tonne. That's about 50,000 ounces a year. And we haven't put a bank between our shareholders and profit in that. All right? But we do ask our shareholders to take a little bit of a leap of faith because we don't have a big, thick book that says feasibility study on it. But bear in mind that 70% of those big, thick books are wrong anyway. So, you know, you just have to kind of deal with that. And top 30 meters in stage 2 is containing, you know, 112 to 140,000 ounces, mainly in the indicated category. And we're finding more veins all the time. And stage 3, look to expanding that. We want the ore body to tell us how big the plant should be. We don't want some accountant or some modeler in some consultancy to tell us, well, if we want to produce 100,000 ounces a year, you need to plant this big at this grade and those kind of things, because that's why projects fail. We want the ore body to tell us that you can mine me at this rate, and I will release my gold at a suitable rate that's appropriate for that. So if we start small, we can expand this up accordingly. Growth potential, we're finding new veins all the time. The western limb and the eastern limb of Old Pirate both continue up several hundred meters. The Golden Hinds to the south, which was a very exciting day, right? We discovered it in a day. This was a vein that was mapped twice by Newmont. There is a lot of gold in the Old Pirate area that contains no gold. A lot of quartz that contains no gold, right? And it's generally bucky white quartz. This vein was mapped twice by Newmont and mapped twice by us. No offense to Newmont geologists, none to ours. And for 400 meters of strike length, we thought, well, it's sampled at one end, it's a barren vein. But then we just noticed, it was July last year or June last year, we noticed a little bit of anomalism in the central part. It fell between the sampling areas through here. So we sent geologists back out there, have a look at this vein. It's just, you know, we've driven past it 1,000 times. And she called me up the next day and said, you know what, there's actually this sort of 60 to 80 meter section in the middle that every sample I have has got visible gold in it. And somehow this vein has turned on and off. 400 meters of nothing, middle bit is turned on and off. Now, it's actually multiple structures through there, so it drills very well. We've had some excellent drill results, including 42 meters at 44 grams per ton. It really seems that these two faults that shunt this is closing it off at depth, but we'll know that once we mine it. But in the top 50 meters or so here, we have 113,000 tons at 16.5 grams, but really a lot of it's in that 34,000 tons at 1.5 ounces. This de-risks Old Pirate. This and that gravity gold plant, you know, if you do the sums and look at those grades, and it's all free coarse gold, we'll generally, you know, look at substantial returns. The gravity gold plant's on skids anyway. We'll just take it away if we don't go much further beyond that, but obviously we intend to do. Thanks to the guys at Standard Chartered, some of the guys here, they put together this slide for me back in September. I'm sure all these valuations have changed and all those kind of things, but it shows Old Pirate plotting more similar to the underground 2,000 Filipino or Indonesian miners chasing veins underground than it does to big mechanized mining operations from a cash cost basis in Australia. Size of the resource is size of the bubble is the resource on that. So compared to some of the other things in and around the place, it's just, you know, Australia's just an expensive place to do business. It's expensive for, you know, I remember Gavin Thomas talking about how much it costs to pay a jumbo operator underground at Dominion, and then he went to work for Rio Tinto or something and set you back a couple of weeks or something like that, right? The Challenger, sorry, not Dominion. 2 Ks away is the reason why we bought this project. 3 Ks away is the reason why we bought this project, right? It's because of this really bizarre porphyry. There's, you know, it's a back arc porphyry. It's not like an arc-related porphyry. It's in a sedimentary basin, but it's a monzonite nonetheless, and it's porphyritic, and it's got gold in it. And the resource is, you know, 2.67 million ounces of low grade, but we did work on the high grade optimization of that. And this forms a much longer development strategy in this. So 15.3 million tons at 2.2 grams is a very respectable resource in that. What it looks like on the high grade zone. Get in there, Mick. This is what some of the rock's like. So I'm not going to dwell on that. I've probably spoken enough on this. But, you know, this is something we still need to find the edges of. This is a key part of making this into a 20-year operation out in this district through here. I must add that we've got 80-odd different targets on Old Pirate alone, right? On the Twin Bonanza projects and Old Pirate alone that we need to work on. And then 33,000 square kilometers. We won't let it go fallow. There is, you know, over at Tulsa and Quota, over on the eastern side there, we've got some excellent, I consider this one of the best exploration areas in our portfolio in terms of the amount of anomalism. Tens of kilometers of surface geochemistry anomalism through there. And some very interesting drill hole intersections. Sniff of copper and silver down at the Stafford Gold Zone to the south, Reynolds Range area. Then Lake Mackay. This is the location where the last lost Aboriginal tribe was, was discovered in 1984. Now, they weren't lost. Nor were they found. They walked out during a drought, and I've met one of the guys from there that was raised as a child with no knowledge of the Sydney Mining Club. Can you believe? And you know, let alone he's a massive football fan now. He became a Collingwood supporter for some reason, but you know, not having that as a child. So I'm just going to summarise. You know, we're going to roll some closing credits shortly, but we're passionate about what we do. We're exploration driven, but we recognise the uncertainties in mineral exploration. And value in mineral exploration and risk is about recognising uncertainties. You know, when I say I've got 1.8 million tonnes at 10 grams, people think I've got 1.8 million tonnes at 10 grams. Well, I've got 1.8 million tonne estimation at 10 grams average estimation. Right? And they're key important factors here. And if you invest in mineral companies on basis of inferred resources, you should go and read the definition of an inferred resource, because it will scare the pants off you. Right? It's basically, I think it's there, maybe. Right? If you've got geology, it really helps on that. So we do not make any representation really around that, other than to declare what we need to within this environment. We have full disclosure at all times, lots of regional targets, good track record of discovery in the company. And I just have just some of the closing credits. Apologies to Bob Dylan.